Well, hello everyone. My name is Roger Scott. I'm the senior trader for Wealth Press. Today is May 7th, and what do I always say? Let's get into it right now. Now, I wanted to wait a little bit to do the report a little bit later today because we had jobless claim numbers come out. The consensus was about 3.041 million, and the actual number came out just a little bit higher, which is not that bad. The expectations, the numbers are actually getting a little smaller. It peaked at just under 7 million in late March, so the numbers are coming down. The question is, are they going to rise again? But so far, the numbers are the numbers are just crazy. We got 30 million over the past 6 weeks applying for unemployment. But the real question is the pattern getting better or is the pattern getting worse? And it appears to me that the pattern is getting slightly better. We're not seeing 7 million, 6 million, we're seeing closer to 3 million, which again is bad, but the fact that the number is not increasing is very positive. Let's talk about the overnight markets. Stock market and price of oil pushed higher on Thursday ahead of the latest weekly jobless claims, which is what I just talked about a second ago. Figures in U.S. and China after China reported a rise in exports as the pandemic lockdown eased. That's interesting. The labor market in the U.S. has been a focal point, which is why we started with that today. On Thursday, government data already showed about 3 million. See here, they're talking about 3.5 million, but we have less than 3.5 million. That's positive. That's very positive. Saw jobless 8, bringing the total to nearly 34 million. About 33 something. I'm not going to mince numbers, but again, it's not good. But the trend is getting a little better since the shutdown began several weeks ago. On Friday, monthly report, that's tomorrow, is expected to show the unemployment rate jump to at least 16% in April from 4.4% in March. That's the expectation, 16%. If it's better than 16%, the odds are the market will rally. Now, Chinese trade data showed an encouraging 3.5% rise in exports in April. That's pretty good. Driven by electronic shipments, textiles, which include a surge in mask exports. The data shows China exports in the United States rose 2.2% in April, while imports of American goods fell 11% in reflection of weak Chinese industrial and consumer demand, despite the lifting of most antivirus controls. Imports fell 13.7% from a year earlier on 179.6 billion, worse than the first quarter 2.9% decline. But total exports rose 200 billion, a turnaround from the 13.3% contraction in the 3 months ending in March. Comments by President Trump raised the possibility of a further trade friction. We really don't need that right now, folks. With Beijing have worried investors hoping for better times as other economies begin to reopen. Trump said he would soon assess progress in a preliminary trade agreement with China that took effect in January. Boy, oh boy, extending a truce in a painful tariff war between the two world's biggest economies. The possibility of a revived friction over trade at a time when economies have been slammed by the pandemic and resulting in travel restrictions has rattled investors in Asia, where China is the main driver for economic or regional growth. I agree with that 100%. I think it would be a major mistake right now for Trump to start talking about trade war. I think we should let this coronavirus settle down before we get that far. Now, as far as tomorrow, I did want to show you the expectations, the employment expectations. And again, 16 million is what we just read. But as you could see here, 16.4% right here is the consensus. It's all the way from 12.3 to 18.9. But we're looking at, look at this, 4.4% all the way to 16.4%. I wouldn't look at the non-farm payroll change. I would look at the unemployment rate. And when you have 4.4 going all the way up to 16.4, the expectations, and look at the consensus. When the consensus is all over the place like this, 12.3 to 18.9, you really don't know what's going to happen. But the expectations are right about 16%. So if you see unemployment 13, 12, 11%, that's positive. If you see it at 17, 18, 19%, that's very, very negative. Now, today is Thursday. What do I usually do on Thursday? I talk about the worst stock or the worst sector or stocks that I don't like. And today, usually the way I start my analysis on my weakest stocks, I look at stocks making 90-day lows. Usually when stocks are making 90-day lows, the chart patterns begin looking very interesting. And I like this one in particular. I like this double bottom. It looks like it's about to break down. The stock is Lowe's, but not like the department store, not like the consumer store Lowe's. This is a different company. It's Lowe's, but its ticker symbol is L. So if we look at this stock, let's look at this stock. It's a insurance stock. Don't confuse this with the store Lowe's where you can buy all the home building products. This is different. This is an insurance company, Marine Casualty Insurance, which is in the financial sector. So we have a stock right here, ticker symbol L. As you can see here, it looks like it's about to break down. It's been in a downtrend, and it looks like it's been congesting. It went higher, it had a little dead cat bounce, and it's about to break lower. It's in the financial insurance sector. As you can imagine, business services right now, financials, no, they're not looking good. As a matter of fact, let's look at our 10 sectors so we can verify and validate that. So we look at our 10 sectors. Let's look at the table because we want to look at strength versus weakness. We look at that right above energy. Energy is the weakest sector, and financials really just one above. So out of 10 sectors, it's the 9th weakest one. Now, I just want you to kind of go see kind of the analysis that I go through in my head. Excuse me. Now, energy we got to be really careful of. Why? Well, I like energy for a short, but there's too much short. There's too many short positions, and energies have been just hammered. So I'm afraid we're going to see a short squeeze, which happens when you have too many short positions. The stock starts rising, and all the shorts cover their shorts, and it causes a rally. We're seeing that right now, actually. What's the stock we're seeing? We're seeing that right now with Match.com, a dating site, M-A-T-C-H, Match.com. It had like close to 60% short interest, and the stock is going higher right now. People, I guess, are lonely at home. They want dating online. So, and Match is the leader, and the stock was suffering, and now it's breaking out. It's near all-time highs, or at least recovering. I'm not sure if it's near all-time highs, but the open interest is going lower and lower, and that's called a short squeeze. So we don't want to see a short squeeze like that on the ticker symbol Lowe's, L, ticker symbol L. So we like the financial. It's not too bad. It's not as bad as the energy sector, but it looks like it's weakening, and it's already on the 9th. Out of 10 places, it's on the 9th. So it's a good short. I like the position. I like the stock. Let's look at the fundamentals. 5-year return, negative 26%. 3-year return, negative 35%. 1-year return, negative 41%. Let's look at analyst ratings. There's no analyst ratings, which means there's not a lot of or very little institutional sponsorship. And as you can see by this graph, the stock has been going lower and lower and lower. So now let's look at the technicals. Notice how I did everything step by step. I looked at fundamentals. I looked at the global markets. I looked at the 90-day breakdowns, not breakouts, breakdowns. Then I found the stock that I liked. I confirmed that it's in one of the weakest sectors. I could have done it the other way around. I could have started with the sector and then got into the stock, but I've been doing this for a while. So if you look at the 9-month chart, notice the stock going down sideways, 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 breaks down, has hardly an upside, and then breaks down again and now is at its lows. That's the kind of stocks we want. We want stocks that are struggling, trading below the 50-day moving average, the 200-day moving average, industries that are doing bad. Can you imagine all the insurance claims, all the insurance problems that we're going to have right now with all of these coronavirus, all these companies being closed? It's going to be a mess for the foreseeable future. I do not see this company making money. So if you were to sell this stock, I would wait for it to trade below 28.70. I would put a sell stop at 28.70, okay? And I would put a buy stop, once I'm short, I would put a buy stop right around this swing high, which is right around the $37 level. And it's great because it's very close to the 50-day moving average. And if it breaks above the 50-day moving average, you probably don't want this stock. Notice the blue line is the 50-day moving average, and notice it's been staying below the 50-day moving average the entire time. So I would put a little alert for yourself at 28.60, and if it breaks 28.60, then I would go short. And then I would cover my short right around the 37.10, 37.05 level. I hope that helps you with figuring out how to trade. So we looked at fundamentals, we looked at technicals, we looked at 90-day breakdowns, we looked at the sector, we made sure the sector was in one of the weakest sectors, we looked at the stock, we made sure it's in a strong downtrend, we made sure it's trading below the 200-day moving average, below the 50-day moving average, near all-time lows, and then we're going to sell it when it breaks the all-time lows. We want everything working in our favor. All right, now, folks, there's going to be a surge of post-quarantine spending with governments slowly reopening. It's happening, and we're likely to see some huge spikes on the stock market today. Look at the unemployment data I was just telling you. It's already getting better. We were expecting 3.5 million people. We got slightly more than 3. So things are getting better, and we're not seeing 7 million or 6 million unemployments. The numbers are getting better. Now, I've already found some flash crash, fast cash stocks that have already started moving. That's right. In fact, my number one stock pick that I've already mentioned yesterday is already climbing today. So, you know what I decided to do? I decided to put together a little training video to teach you how to cash in big on my latest post-pandemic moneymaker. How about that? Click the link below or the button at the end of this video to get in on this exclusive information right now. Folks, if you like what you're seeing in these daily videos, you're going to learn so much more from my events. You don't want to miss it. Follow the link below. This account is near all-time highs. You don't want to miss it. Again, find the weakest sector, the weakest stock. When things are looking bad and you short them, you find the strongest stock, strongest sector, and you go long. You go with the flow. Again, follow the link below or click the button at the end of this video. Flash crash leads to fast cash. Don't miss out. Get in on this now. Follow the link below. I'm so excited about this, I can barely contain myself. I'll talk to you guys later. You have a great day.